Hey, Heaven, long time no see.
You just scared me.
Sorry.
I should take a drink of my coffee, and then you said that, and I like jumped. I was like, oh, okay. That was funny.
Morning, Tiffany. Okay, I'm going to get started here today. We're still continuing our discussion about basic financial literacy. And last week we had talked about budgeting and a little bit about personal taxes and how you file them and things. And today we're going to kind of start talking about another big part of your financial life, and that is credit. Credit is the ability to borrow money. And when you borrow money on credit, you get a loan and you promise to pay it back with a little bit extra, the interest. So basically, if you use your credit card, not your debit card is something different. A credit card, what you're basically doing is saying, I'm going to buy this, I'm going to borrow the money from MasterCard, Visa, whoever, and to buy this item, and I will pay them back the money with interest. So having good credit, and basically good credit is defined as paying back those loans timely. And having good credit can make it easier to do things like borrow money. Other people will be willing to loan you more money if they see that you are paying it back and are responsible with the money. Get approved for a credit card, rent an apartment or house, qualify for a car loan, get better interest rates on credit cards and loans, get better car insurance rates, avoid security deposits on utilities. And a person's creditworthiness is typically measured with a credit score. So every time you do something on credit, that is reported to one of the three major credit reporting bureaus who have formalized a way to give you a score based on your activity. And the higher your score, the better off you are, and the more trustworthy you look to people who look at your credit report, that score, to determine whether or not you're a trustworthy person to lend money to. If you have a lower credit score, it doesn't mean they might not loan you money, but it also means they're probably going to charge you more interest to cover the risk of loaning someone who might not be as trustworthy money. So the most common credit score is what is known as the Fico score. It's named after software developer Fair Isaac and Corporation, who came up with the algorithm to calculate this score. So a person's FICO scores are provided to lenders by the three major credit reporting agencies in the United States, and those are Experian, TransUnion, and Equifax. And these help lenders evaluate the risks of extending credit or loaning money to people. So if you go down to Dorset Automotive down on the corner and you say, I want to get a car loan to buy a car, they're going to run your credit report. They're going to look at your credit score, and then they'll determine whether to give you the loan, and if they do it, what interest they're going to charge you for that loan. So lenders typically review what we call the 4 C's when making a decision to grant a loan. Capacity, and that's your present and a future ability to meet your payment obligations. If they look at, when you fill out the loan application, you're going to list all of your current debts and bills. You know, how much do you pay on your utilities, your phone a month, things like that. How much do you owe for college loans? All that is on there. And they're going to go, okay, you only make $50,000 a year, and you have, you know, your annual debts are coming up to $49,000 a year. You don't have much capacity to take on a new debt because you still have to pay for food and daily activities, gas, all those other things. So you're a very bad choice to lend money to based on your capacity in that case. Capital. If you don't pay and we have to come after you, what can we get from you of value that will make up the difference between what we loaned you? And that is capital, the value of your assets and your net worth. Character. Character is purely defined by your payment history. How often are you late on making payments? How many payments have you missed? And then lastly, collateral, the property or assets that will actually secure the loan. In case if you go to borrow money for a car, the car itself is the collateral. If you don't make the payments, someone comes and repossesses the car. Same with your home. So when evaluating the 4Cs, the loan officer is going to ask you questions such as, are you employed? How much money do you earn each month? What are your monthly expenses? How much money do you have in bank accounts? Have you had credit in the past to prove that you are trustworthy? How many credit cards do you have? That goes towards your capacity. What collateral can you offer? And you can be denied for a loan if you're unable to demonstrate that you have capacity, capital, character, and collateral. So for example, you might get turned down if you have a history of making late payments, if you've ever filed for bankruptcy, if you had property repossessed or foreclosed, if there's a court order requiring you to pay money to a lender or creditor. Your credit score is going to affect your ability to qualify for different types of credit and varying interest rates as well. In general, the higher your credit score, the better your loan terms. And the following chart details the annual percentage rate, what we call the APR, available to people with different credit number ranges, along with the corresponding monthly payments and total interest paid. And the chart's going to assume a 30-year fixed mortgage for $150,000 and the interest rates that were current when I wrote this, March 26, 2013. So if we look at a FICO score, and we'll start at the bottom of this chart here, between 620, 639, not a great FICO score. You're looking at an annual percentage rate of 4.847% on that $150,000 loan. And that would make your monthly payment $791. And the total interest to be added to that $150,000 over the course of this loan would be $134,855, or so $134,855. That's almost $150,000 in principal that you got to pay for the house to begin with. In other words, that low credit score right there, that change in percentage rate from the bottom one to the very top one is only about 1.6%, but it almost doubles the cost of what you're going to buy. That $150,000 home, you're basically paying close to $300,000 for it now. Whereas if you look at the top here, a score between 760 and 850, and 850 is the highest you can go, well, now you're getting an APR of 3.258%. And again, it's only a 1.6% difference, but look at what it does to the total cost. Now your monthly payment is $653. Your total interest over the course of the loan is $85,249. That's almost half of what you're paying in interest at 4.847%. So having good credit can save you a lot of money if you demonstrate that you're responsible with your money and it's reported and everything, it's good. Now, there are some people out there like Dave Ramsey who says you should have a credit score of 0. It shouldn't matter because you should pay for cash with everything. And, that works great as long as it's small purchases. But sometimes big purchases like home ownership, if you had to save for a home, it might take you 10, 15 years to do so, as opposed to just getting credit for these major things that you might need in life. So there are arguments both pro and con for having a 0 credit score there. So these figures clearly show how your credit score can impact the interest that you pay on a loan. A better credit score can save you tens of thousands of dollars on major loans, such as a mortgage. And if you want to look at different scenarios based on varying credit scores and interest rates to see how it would affect you, actually FICO has a pretty good website where you can plug in numbers. They use their algorithm to calculate everything for you. And that's at myfico.com/myfico/credit central/loanrates.aspx. And you can select the type of loan, the state where you live, the loan principal amount, different FICO score ranges to look at these varying scenarios. Unfortunately, for a teenager just going into the market, you do not start with a clean slate. You don't start with a credit score of 800 right off the bat. Individuals have to earn their good numbers, and that can take time. According to data compiled by Credit Karma, there's a correlation between age and average credit scores, with scores rising as people age and have more demonstrable proof of character. They have more collateral. They certainly have more capacity as their earnings grow, things like that. The average credit score for 18 to 24-year-olds is at the very bottom of that chart I just showed you. It's a 638. So you're starting kind of behind the 8 ball there. And even when all other factors remain the same, a younger person will likely have a lower credit score than an older person. And that's because the length of the credit history accounts for 15% of the credit score in this algorithm. And so you can be at a disadvantage simply because you don't have the length or depth of credit history of someone older than you. So what is calculated in this algorithm? Well, think of it as a grade in my class. It's weighted. And there are 5 factors included in weighted to calculate a person's FICO credit score. 35% of the weighting is your payment history. Have you ever been late? Have you ever missed payments? 30% of the weighting is the amounts you already owe. In other words, your capacity. 15% is the length of your credit history, and that's where age, being young, will affect you. 10% is new credit and recently opened accounts. If all of a sudden you go on a flurry of opening new accounts, they think you're trying to use credit to cover up a lack of actual physical funds, and that will count against you. And the other 10% is the types of credit in use. If you're having to go and take your title down to one of these car loan title places up near the interstate, and you're borrowing money from them, they look at it as, okay, this person needs cash quick. There must be something wrong. So the type of credit can also affect, how your credit score is viewed. So the most important thing you can do to help build your credit is to learn how to manage money responsibly. And that's where that budget we talked about last week kind of comes in. Those skills and habits go a long way towards reaching a good credit score. Now, that being said, there are a few options for helping you establish credit. Be added as an authorized user or a joint account holder on your parents' credit card, not their debit card, their credit card. And in order for this to work, though, you have to pay your portion of the bill on time. Otherwise, it'll end up hurting you and your parents' credit. Learn to use credit responsibly even before you have your own credit card. For example, as an authorized user on your parents' account, you should avoid charging more than you can comfortably pay off in full each month. And balances should be kept low and well below the credit limit. Some 18-year-olds can get credit cards, and though most will still need an adult cosigner until they hit 21, but what they'll need in order to get that credit card is a steady source of income to qualify, and an allowance doesn't count. This has to be income from work. So you have to prove that you can pay off the debt, basically, that you have regular income coming in the form of a paycheck. Now, I will say this, when you get to college, you'll go down to check that campus mailbox in your dorm, or even when you get your first job and you move into an apartment, you'll get mail all the time from credit card companies asking you to sign up for, hey, you qualify for this card. Look at this interest rate. It's only 25%. And you already saw what a 1.6% interest rate change will do to how much you owe in interest. And it's very tempting to go, no, I'm not making a lot of money. I could get this credit card and I could take, my girlfriend, boyfriend out to dinner or movie, go hang with my friends, and it'll be okay. It's like free money. And it's very easy to get sucked into that. Matter of fact, a lot of people say these credit card companies are targeting you because of your lack of knowledge and experience here at these things. And then all of a sudden you start drowning in debt. You're paying off, the minimum on your card every month, and they're still charging you interest on what's left over. So that interest continues to accumulate, and you might have had a $5,000 limit on that card, but after 2 years of using it, you now owe $25,000 to them. So it's very easy to get sucked into that and to fall into debt as a result. So avoid applying for multiple cards, even if the deal looks great. Applying for multiple cards can actually lower your score dramatically since you'll appear desperate for credit. Consider retail and gas cards, since they're typically easier to obtain approval for than a Visa or MasterCard, and they're often limited at where you can use them. If I get a Marathon card, I can only use it at Marathon stations, and of course, not everything I would need in life is in the gas station convenience store there, so I'm kind of limited on what I can buy, so that kind of limits how much I can actually spend. And be sure to ask if the card requires payment in full each month, or if it allows minimum payments like a credit card. American Express is a very popular credit card because it actually requires you to pay everything in full each month. Whereas MasterCard, Visa, if you use them, they'll charge you the interest, and if you only pay the minimum instead of the full amount, then that interest will be added on the next month to whatever is remaining as well. So if the card must be paid in full each month, it may not be reported as revolving, and therefore will not help your credit. So pay it off in full each month, even if it's not required. And make sure you pay all of your bills consistently and on time. If you miss a payment to the city of Marshall for utilities, they report that to the credit reporting agencies, and that's a missed report. If you have a library book checked out and you don't return it, they fine you. They report that to the credit companies. and therefore that affects your credit. So all these things, if you get a traffic ticket and you don't pay it on time, they report that to the credit card company. So there's lots of things in life that are reported to these credit reporting agencies that can affect your scores if you're not making the payments on times. Now, it's important to note that most prepaid credit cards and debit cards will not help you build credit because you're technically not borrowing the money. On a prepaid credit card, you're paying them the money up front, and that's what's getting put on your card. Same with a debit card that's tied to an account. You're only getting to use the money that's in there. You're not borrowing money and repaying it. So read the fine print for details on that stuff. So that's all I have for credit for you to kind of get a basic feel for it. Now, we're going to talk about two big things that you might likely use credit for in the upcoming future. And those are cars and college. So the two biggest expenses on your radars right now are probably one of these two things. And without enough cash to pay for these large expenses outright, a lot of teens and parents are going to seek installment loans. And that's kind of what college loans and car loans are called, installment loans, because you don't pay it all back at once, you pay it in installments. So it's where a set amount of money is borrowed and repaid in fixed monthly payments, installments, for a specific period of time, typically over several years. The normal length of a car loan is 5 years. College, they'll give you 20, 30 years to pay that off usually. So an installment loan differs from an open-end credit like credit cards because the lender allows you to borrow against a pre-approved credit line. In other words, when you go to college and let's say you get out a Stafford loan, the government is the person most likely you're going to borrow money from. The Stafford loan says that, okay, we're going to give you $15,000 this semester. And then once you get out of college, that will start accruing interest and you'll be expected to make payments over a period of time for 20 years. And each month's payment is going to depend on how much you borrowed. Now, there are two types of installment loans. There are secured loans and there are unsecured loans. A secured loan is backed by collateral, something of value that the lender can take if you default on the loan. And as I said earlier, with a car loan, that collateral is the car. If you don't make payments, they will come and repossess the car. And so a car, a house, those are types of secured loans. And because of the collateral, the interest rate for secured installment loans is comparatively lower than unsecured loans. And like I said, a car loan is a secured installment loan. If you stop making the payments, the lender can take the car from you and sell it to recover some of the money. You're still responsible. Now, let's say you paid $10,000 for the car. That's how much you borrowed. You've only made $2,000 in payments before you stop. They come and repossess the car. They only sell it for $5,000. There's still a $3,000 deficit there that actually you are still responsible for. So it's not like you're clean and cleared there. So you're responsible for the difference between what you owe and how much the lender can get for the car. Now, on the flip side of this is the unsecured loan. And an unsecured loan is one not backed by any collateral. And this is what student loans are. Student loans are so you can go to school and increase your knowledge. So if you don't make the payments, it's not like they can come take your brain or something. So this is an unsecured loan. They're taking a greater risk. And as a result, they're going to charge you more for that. So interest rates for things like student loans are going to be a lot more than they are for a car loan. So because of this, exposes the lender to more risk, the interest rates are comparatively higher than for secured loans. And a student loan, like I said, is a type of unsecured installment loan. So let's talk about buying a car specifically here. In general, you must be at least 18 years old to be approved for a car loan. If you're not yet 18, your parent or another adult can be a co-qualifier on the loan with you. And when I was in the Army, I had to counsel a lot of young kids who they got that first paycheck, they're living on base, we're paying for their housing, their food, their clothing. They feel super rich. And so they go buy some $40,000 car, but they're too young. And so their parents sign up for them because they've been telling them about how much money they're saving and everything, and that they'll make the payments. And then they stop. And then all of a sudden, mommy and daddy aren't getting letters or phone calls from them, and they call me, and I have to go hunt them down and say, okay, what's the deal? And come to find out their car's about ready to be repossessed. They've ruined their mother and father's credit because they were co-signers on it, or they're coming to take their cars in payment. So it's a huge mess. I would recommend not getting a co-signer. Just be responsible for yourself. But if you do need a co-signer and you get one, be responsible to pay those things so you don't ruin someone else's life as well. So you can obtain a car loan from banks, credit unions, finance companies, car dealerships. And it often pays to shop around. You're not tied to your bank when you go out to get a loan. It's not like, okay, well, I have my checking account at First Financial, I have to get the loan from First Financial. No, go check out interest rates at different places. See what they're in competition. So they'll try to strike a good deal with you to bring you in as a customer and make money off you. So find the best loan terms, including the most favorable APR, most favorable loaning fees and finance charges. Before you buy a car, though, it's very important that you understand that paying for a car is only the first expense, because you're going to have a lot of associated expenses you probably already know from driving the car you drive now. There's insurance, gas, maintenance costs, and any tickets and resultant increases in insurance premiums if you have a lead foot. So all these things have to be taken into consideration when deciding whether a car makes financial sense for you. And if these expenses will be too much of a financial strain, you should seriously consider waiting. Bike, walk, use public transportation as much as possible to kind of save your budget. Because your parents will likely be a co-signer on the loan if you get a car young in your name, it's going to be in your best interest to make sure the payments are made on time and in full each month to protect your credit. And that being said, if your agreement with your co-signer was that you would be responsible for the full payment each month, then you should be held to it. Just resist the urge to wait for mommy or daddy to bail you out without destroying their credit in the process. And I've seen too many young people do that and lose family relationships because they were irresponsible and just expected to be bailed out. So there's paying for a car. Excuse me for a second, I'm gonna get a drink here. Talk too much and my throat gets dry. So let's talk about paying for college. And there's no doubt about it. College is expensive and the costs are only rising. And when I talk about college, I'm talking about any post-secondary education, anything you do education-wise after high school. A lot of it will require you to pay something. So aside from tuition, a college's sticker price also includes expenses like meals, housing, fees, books. Even if, let's say, you go into the Carpenters Union and they have an apprenticeship program, they're only going to be paying you minimum wage, and they're going to charge you for books. They're going to charge you for classes still while you're learning, and you'll still have to cover the cost of actually living. So meals, housing, fees, books, all these stuff are still going to be on you, whether you go to the traditional university or some other post-secondary education route. So these costs can be viewed as an investment in your future. If you put in a little bit of money now, you'll get a lot more money back once you become a full-fledged member, what they call a journeyman in most unions, or you have that degree and get a real job. So people with a bachelor's degree or higher can earn more and enjoy more job security than people with an associate's degree or a high school diploma. Not surprisingly, then, college graduates have a lifetime earnings average of $2.3 million over their 35-year career span, with $1.3 million for high school graduates alone. So if you only have that high school diploma and no post-secondary education, you're going to make about $1 million less in your lifetime than someone who has that degree. So one way to reduce college expenses is to take classes at a community college, where tuition is typically low and a lot of classes are transferable to four-year institutions. Matter of fact, in Illinois, they've got this reciprocal agreement between all public community colleges and all public universities, that the universities have to take your credit hours from the community college. They can't make you repeat classes. So these agreements are called Articulation Agreements, and they're intended to provide a simplified and guaranteed transfer process between community colleges and four-year institutions. The agreements typically outline the specific courses that you would take at the community college that are then transferable to the university, and what required letter grades you have to have in each course. And check in advance to make sure your classes will transfer. Usually when you sit down with your counselor to go over your schedule and get approval for the classes you want to take, that's one of the things you'll consider and ask questions about. But regardless of the path that you take, you might still need help paying for college. And there are a number of options for teens and families. The first is financial aid. Federal Student Aid, FSA, provides more than $150 billion each year to help more than 14 million students attend college. And FSA programs include the Pell Grant. Now, a grant is different than a loan. A grant is money they give to you freely. There's no expectation of it being paid back. And something like the Pell Grant is intended for kids who fall below the poverty line, who don't have a history in their family of parents graduating from college. Student loans, there are loans with lower interest rates for poorer students. There are loans for most students with, what they consider the nominal or nominal interest rate as well. But those are expected to be paid back, those loans. And there's work-study programs where you can work for minimum wage up to 30 hours a week on campus at some job. I know Cullum actually has a work-study, and he sits there and answers phone at the university press. And he says he gets like one call a week. So he mostly just sits there and does his homework the whole time. So the first step in qualifying for FSA is to complete the free application for federal student aid, which is known as the FAFSA. And that is something that will be coming up for you in normal circumstances. I don't know how it's all going to work with the lockdown and everything, but normal circumstances around October is when FAFSA will open up and you'll be expected to complete things. And usually Mrs. Fraley is really good about holding workshops on FAFSA for you to come in. I know me and Cullum, most schools require you, whether you need the money or not, to complete FAFSA. And so you'll go in, and Mrs. Fraley has a night, they have it all set up in the library. Me and Cullum went in and we completed his FAFSA form, and they had an expert there to help guide us through it and everything. So applying early though, because that money, they only have so much allocated, and once it runs out, you're out of luck. And so applying early gives you the best chance for receiving non-federal student aid as well. Now, if grants and scholarships are not enough to cover college expenses, let's say you're a C student, a lot of scholarships are out for you, your family's upper middle class, so a lot of the grants are out for you, you can explore the federal loan programs. And let me go, I skipped a page here, if I can find page up. There we go. So you must fill out the FAFSA to apply for federal loans, which include federal Perkins loans and direct Stafford loans. The Perkins loans are the ones that are for low-income students. The direct Stafford loans are the ones for everybody else. And even if you're a low-income student, you might qualify for some Perkins loans money and still need some Stafford loan money in order to supplement it. So you might have a combination of the two. You can qualify also for private loans from places like banks. The majority, over 90% of all education loans, post-secondary education loans, are done through the federal government. But there are still some banks and institutions out there that will loan you money. But because the federal government is the greatest, debt collector in the world, because they literally have the power of the law to come in and take your paycheck from you. So every time you get paid, we'll just take half of that towards payment for us. But a private loan institution doesn't have a lot of that power. So if you get a private loan, they're going to charge a lot higher interest rates for this. So these loans typically have higher interest rates than federal loans, and they require a credit check and do not offer deferment options. In other words, once you take out the loan, you're expected to start paying, and it doesn't matter that you're still in school and don't have a job, they'll expect the payments, whereas the federal government defers that and says you don't have to start paying, we won't start adding interest until you're graduated or out of school. So for these reasons, it's generally better to exhaust federal student loan options before seeking a private loan. All right, so that's my advice to you on credit for college and car. But what's the next big thing that's probably going to be on your radar, particularly after your post-secondary education, is probably going to be a house. And when you are or maybe ready to move out and find an apartment or house to call home, it should be something that is a mutually agreed upon move, that is the result of your independence and maturity and not response to family troubles. I've known too many kids who they get in a fight with their parents. I'm 18, I can do what I want, man. I shouldn't have a curfew of 2 a.m. I should be able to be out till 4. And I'm just gonna go live on my own so I don't have to live under your crappy rules. You're a dictator, a tyrant. And then they move out and guess what they find out? The world ain't sunshine and rainbows. It's a hard, mean place, and they actually have to pay rent, and they're expected to pay for things like their own food, their own utilities, and they find out the world's a pretty expensive place to be on their own. And rather than planning and doing it right, they just left as an emotional reaction, and now they're stuck, and nobody wants them living on their couch for months on end doing nothing, and so they bounce around, and they pretty much ruin their life for a long period, at least very early on. So rather than discuss the reasons behind the move, I'm going to focus solely on the process of the move, assuming that this is a mature decision. How do you rent or buy a place to live? And while most teens are focused on the rental market, i.e. renting an apartment or house, a few of you may be ready to purchase a home, actually. So in this section, I'm going to take a look at considerations for both. And we'll start with renting. Renting property rather than owning is an option for a lot of people who are not yet ready to settle down. and particularly people who will be living in an area only temporarily, such as for college, who are not willing or able to meet the financial obligations of a mortgage, or who choose to enjoy the benefits and flexibility of renting. College and graduate students often rent in order to move out of campus housing. The dorms are crowded places. There's lots of noise and distraction. You don't really get a choice about your roommates. So, a lot of them will say, I'm going to move out in order to do that. So unfortunately, time constraints, I'm limited in what I can talk about housing today, but with the basic knowledge that I just gave you, we will move into that tomorrow. Do any of you have any questions for today regarding this? No one? Everybody's just happy-go-lucky? Sarah's dog is taking class with us today, apparently. Okay, guys. Well, hopefully I'll see you tomorrow then if you don't have any questions, and we'll pick up our discussion on housing then. Guys, have a good day. It looks like a really good one.
Are we having any afternoon classes this week?
Yes, thank you for reminding me. 4 o'clock today, we will start going over a family's 1040 tax return, and I'll do that tax return with you so that you can kind of see how a tax return is done. Matter of fact, one of the big things I always see online is, our schools didn't teach us how to do taxes. Well, here's your chance. I'm going to show you how to do taxes. So.
Okay.
All right. So hopefully I'll see you at 4, and we'll start on that. And that's what we'll be doing all week is that tax return. So.
Okay.
All right. Guys, have a good day. Nice seeing you.